Welcome to the NPWC Wealth Podcast, Episode 2. Today we have Kamran Siddiqui of Spartan Funds. Welcome to the call, Kamran.
Thank you, Cody. Pleasure to be here.
Awesome. Kamran has a very important job for our team. He manages the LSQ Spac Fund, which is one of the private investments that we use in almost all client portfolios. And we're going to talk a little bit about what a SPAC is today and how his fund has performed since its inception.
Great.
So, Kamran, basically, I'll just pull up right now the LSQ SPAC Fund fact sheet, just so we can kind of take a quick look. And if you could just tell the viewers, how the performance has been and a little bit about the fund.
Sure, absolutely. So when we're talking about SPACs, right, the first thing I would tell people is throw out anything that you hear on CNBC, because that's not what we're about. What we're about is SPAC arbitrage, and so you can actually see in our return numbers that we've bested the market since inception by like almost double, right? When you add up all those annual returns, you'll see that we've kind of had a double since after fees since inception, and the S&P's only done just a little bit around half that. And so again, we are an arbitrage fund. So a SPAC, I'm just going to go into what a SPAC is because everybody has a different view of it. At the end of the day, a SPAC is what we call a free look on a private equity investment, right? So if people wanted in the old days, if they wanted to invest in private equity, they would give their money to a private equity manager and then wait bye-bye to it for 5 to 10 years and have no clue as to what's going on, right? And then maybe there's a return, maybe there isn't, but it's locked up for whatever the term is. So somebody came along. It's been around for a while, but really about 20 years ago, somebody came along and said, "Hey, you know what? There's a better way to do this." So the exact same guys that managed the private equity basically started a vehicle called a SPAC, and what they do is they raise the money inside this publicly listed vehicle, and it IPOs and it's listed. Right. So right off the bat, what you have is daily liquidity on these things, as opposed to a private equity fund where, you do not have liquidity. So they list this thing. The money that they raise goes into a trust account. And then so the important thing here to note is that the manager of that private equity fund cannot touch that money. It's managed by a trustee. And there's a trust indenture, and I can tell you that since we've had this thing, since we've had the SPACs in existence, we've never actually had a violation of that trust agreement, right? Like forgetting all the shenanigans that happen in the capital markets, those trust agreements are pretty solid. So the money goes into this trust account. Oh, yeah, you've got the flow chart up there. Mm-hmm. Once it's inside the trust account, now what happens is there's a stopwatch that goes off, and every SPAC is different, and they tell you within the prospectus how long they're going to take. But let's say they take 2 years. So they tell you that within 2 years, we're going to find an acquisition. And if we don't find an acquisition within that time period, basically you get your money back that's been sitting in trust. And while it's been sitting in trust, it's been accumulating interest, right? So for us as arbitrageurs, that's a beautiful scenario, because what happens is we know that we buy this thing, and worst case scenario, we're going to get our money back plus whatever interest has accrued in trust, right? So there's our safety net, is that we know we can't lose money, and we're in it. Now what happens is, as time goes on over their term, let's say the 2 years, they go out and they look for an acquisition to buy. And typically what happens is, at some point they will find and announce an acquisition. And if they find an acquisition, what happens then is over the course of months, they file IPO documents with the SEC, and during that time they make presentations, so all investors know what it is that they're buying, right? And so this process used to take about 2 to 3 months, maybe 4 on the outside. Now it's taking closer to a year, just because the SEC is slowed things down a fair bit, just because of I don't want to get into that. They've slowed things down, so it takes a little bit longer, right?
Yeah. So is that your kind of free look period is extended to 12 months now?
So our free look period is basically from the time of the IPO up until so where we split off is if they don't find an acquisition within 2 years, you get your money back. So that's our free look, and in that case, the free look didn't pay out, but we get our money back.
Yeah.
Right. If they do find an acquisition, now there is more. Now we actually know what it is that they're buying, right? And not just us, but the rest of the market knows what it is that they're buying. And information comes out. So what happened in 2021, which is the frenzy period of the SPACs, is people got all excited about space companies and robotics companies and EV companies, and they took these things to absurd levels, and so that's kind of like the free look. And obviously we participated in that. That's typically not what happens. Typically what happens is the reactions are much more subdued, but we still get that we still kind of get that pop that's inherent in the free look. Mm-hmm. And so now we get to a crucial period. After a period of time, they file their IPO documents and everything. Then it comes to a shareholder vote. And so this is key here. This is where SPAC arbitrage deviates from SPAC speculation, which is really what gets all the press, all the negative press. Every shareholder gets to decide whether or not they want to participate in this new company, which now they have information on, right? So anybody that wants to participate basically takes their the SPAC takes the money out of their trust and issues shares in the new company to those shareholders. So those shareholders then become shareholders in the new company. We never do that. Like, that's, if there's one rule that we have, is thou shalt not own a SPAC after it's no longer a SPAC. So we always either have sold our shares in the market if there's been appreciation in them, or we will ask for our money back if there has not been any appreciation, right? So again, there's our safety net, right? We bought this thing, we've been invested, we've had our free look. If the look doesn't pay out, again, we get our money back. And if it does pay out, we've sold it into the market to somebody else. Mm-hmm. On the right side of there, where you've got that where people actually own the new company, mm-hmm. We're never going to be there. Like, it's just, we just won't do it. And that is because we've got 20 years of history on our side, right? When I first met and spoke, years ago, I did tell you, and I continue to tell everyone, the reason we don't participate there is most of the companies that SPACs buy are overvalued. Very few of them actually have revenues or earnings, and they typically return very poor returns. Like, some of them start going towards zero right out of the gate. In other words, others will take a few years, but they always inevitably head lower. So we're never involved in that, and unfortunately that's what the press picks up on, because that's what the press does. Mm-hmm. And so then you get all these negative headlines out there about SPACs are bad, SPACs are bad. You can see from our return profile, SPACs are awesome. Yeah. If you play them the right way, right? Which is what we've been doing for. I personally have been in this market since the beginning, about 20 years ago. Yeah. And obviously with this new fund here, since we've launched in 2019.
Mm-hmm. Yeah, and the way because we've had a number of calls, I've been learning this, and it's taken me, quite a few calls to
Yeah.
get my head around just the highest levels of this type of investment. But the way I kind of explain it to clients is LSQ and yourself, you guys invest in a bunch of SPACs at any given time. Like, is there
Correct.
100 that you invest in at any given time, or?
So right now there's just over 450 of these out there.
Yeah.
We own about half of those. We own about 200 of them.
Okay.
And so, our average position size is just over 50 basis points in the ones that we own. So,
Of
it's
your
not like
overall
we're gonna,
portfolio.
we're
Yeah.
not gonna, load up on, one SPAC. We
Yeah.
treat these as a portfolio because again, you never know which one's going to go, right? Like it's they call it a blank check company, and it's because you never know what's going to happen.
Yeah.
So
So you're essentially, say you have, let's say 200, you're giving money to 200 different SPACs, and a SPAC, a simple way that I kind of understand it is it's almost like a group of professionals that have like a shell company, and
correct,
they're looking on the market for a private company who's ready to go public.
correct,
And they make an agreement with that private company to go public through their SPAC,
correct.
and that company gets put inside this SPAC. And how does that part work with that, between when the SPAC finds a private company,
Right.
they make a deal? When is that announcement trading on the market where you as LSQ can sell that at a premium because there's a lot of interest in the public market in that particular SPAC? How does that part work?
So it's basically a merger, right? What happens is the SPAC is a listed entity. It's a listed company that's trading on an exchange already, and so they go out and buy this private company, and so it's a merger, and the private company merges with the SPAC, and so anybody who chooses to stay in the SPAC now basically owns this private company that the SPAC has purchased or merged with, right?
So between, what is the period where you have the opportunity to sell this at a premium because there's a lot of interest in the SPAC? Is
Okay,
that just during the conversations when people hear, through the streets that, there's a conversation between the SPAC and this private company, and the price pops up temporarily?
right. So it's important to note and that we can actually trade this thing all day, every day, from the time of the SPAC IPO all the way up until the time of the merger or the liquidation, right? So we can trade it all day, every day, anytime we want.
Mm-hmm.
Typically, and that's actually how we build up the portfolio, right? Because as everyone gets excited, they bid these things up, and we start, decreasing our positions, or as as there's a whole bunch of negativity and people start selling these things, we start buying them up again, right? So we trade around the whole portfolio. It's I will show you on the next slide. We have a kind of an example of something that's that's trading now that we're active in or have been
Okay.
active in. But
Yep.
really, we can trade this anytime from the time of the IPO up until the end. Now,
Yep.
typically what happens is most of the interest comes in after a deal gets announced, because now people actually have something concrete that they can point to and do some kind of analysis on, and just determine if this is a viable business that they want to own or be involved with. So
Mm-hmm.
that's typically when when the pop will occur.
Yep. So that's acquisition found. Like, once there's an
Correct.
acquisition found, information is released.
Correct.
You still are an investor, but you don't have to make a decision yet whether
Correct.
you want to take this company public or not. You just get to kind of watch the price and see if it trades up high enough where you want to
Correct.
sell it at a profit for investors.
Correct. And for us, it's never about the individual company. We trade this thing as a portfolio, and that's really important to note. Like we only own half of these things at any given time, and part of that is because of valuations of where different ones are in their life cycle, because we don't want to own anything that that's gonna cause us harm in terms of if it's trading above its the amount that's in trust. But part of it is, the more money you have, the more different things that you can buy. And so again, we treat this as a portfolio. Individual names, yes, you make money, you lose money, whatever. But for us, the overall portfolio is what we're concerned about, and we structure it so that we always have something to fall back on. That if the market were just to go to zero and no deal ever gets done tomorrow, we've got a bit of a cushion there to make sure that we're kept whole.
Yeah. And that was another interesting part is the IPO of the SPAC, usually at $10 per unit, and then they're trading on the market. So that's often when you'll pick them up, and sometimes they can be trading below that $10 value, which we can consider their actual net asset value, which you'll get back at the end of the period. And then sometimes they're trading at a premium to that. Is that kind of like when there's a lot of excitement in the market and stocks are trading high and everyone's paying a premium for stocks, or when there's fear and things are trading below their typical value?
That's exactly it. So we will typically get some in the IPO. We will pick some up in the aftermarket. We will wait for some of these things to trade, even lower than trust. So then we get a bigger cushion to make our money from. So we will trade. Well, we will trade it around. Like it's not as simple as going out, getting the IPO, because not everybody gets in on the IPO.
Yeah.
And sometimes the IPO trades lower, right? So we always, you never know what's going to happen. So that's why we try and get some on the IPO. Then some will wait and buy some in the aftermarket.
Yeah. And are there certain IPOs, like certain SPAC teams out there, where you want to try to get in on the IPO because the team has a good reputation and you feel like it's going to trade up based on their reputation, and others where you're like, what, I feel like after the IPO this might drop a little bit and I can get it at a discount?
So that's the theory that a lot of people go on. We ourselves are pretty agnostic. Because again, I've been doing this for 20 years, so I've got 20 years of history on my side, and I can tell you that there are some stellar teams that everybody's after. They've had liquidations, right? And then there's a whole bunch of no-name teams that no one's ever heard of before, and they come out and do a good deal, right? So while the market may tilt towards better-known teams, we try and be pretty agnostic. And again, it's just history on our side. Like we don't want to own everything. If things are trading above trust, what happens is that's actually a prime way to lose money in a SPAC. There's two ways to lose money in a SPAC. You buy something above trust, and then they don't do a deal, then it goes back down again. So we will buy some of these things, but again, for the portfolio, we want to make sure that the portfolio is trading below trust. But that's one way to lose money. And then the other way to lose money is what I said before, is you own these things after they de-SPAC. And that's the fastest way to lose money in this market, in the SPAC world.
Yeah. So whoever's part of the IPO of a SPAC typically is, just say you're putting in $100, you're getting 10 units at $10 each.
Correct.
And that is what's going to be returned back to whoever owns that portfolio at the end of the period, if you choose not to take the company public.
Correct.
And if right after the IPO, those $10 units trade down to $9.50, you're going to get a 50-cent appreciation on the unit.
Correct.
For sure. And then there could be upside beyond that.
Correct.
And if you buy it above that $10.50, if you hold it to maturity, you're going to lose 50 cents per unit, but you have the potential for upside if those shares trade up to $11 or $12.
Correct. So, you mentioned 950, right? That's only happened a couple of times. Like, we typically don't see 950. That's a gift that everybody should try and get in on. We've seen that a couple of times. We saw that, briefly in 2008 when everything was falling out of bed. some of these things traded down there, so we were lucky enough to buy them. It
Mhm.
happened briefly in March of 2020. When everything was just kind of falling out of bed, and we had a brief opportunity to pick things up. So those for us, like if you go to March 2020, right, that was a negative period, but that's because things that we had already purchased, below trust went even further below trust. And that's the big opportunity in SPAC land, where you can actually go out. So if you look at that March, right, so we're down just under 5%, right? Well, what was the S&P down during that period, right? Like it was around 20%.
Yeah, that's right. That was the biggest down month, wasn't it?
That was the biggest Dow month. And so the reason for that is, there's a brief slice down, and then everybody says, "Holy crap! We can buy these things for $9.50 on the for a $10 unit. We know we're going to get guaranteed $10 back, worst case scenario." And so that opportunity lasts for a few days, and you kind of go in and you buy them, and then you're set. So we don't see 950 very often. Like I said, it's a gift, and unfortunately, that's also when investors run the other way.
Yeah.
Right.
Yeah.
So.
Yeah, because that's when the COVID pandemic first started. There was the most fear out there in the stock market. All the stock markets were plummeting.
Yep.
And then they recovered. But I'm seeing some, positive 14 in June.
Yeah, so I'm going to get into that. 16
in November. What brings about something like that?
So that should not have happened, right? That's an anomaly. And during that period, we just kept telling our investors, look, don't expect this, because we've had some great years every month. And so you don't expect that. And so what would happen in that time period is the rest of the market, right? So you've got the Fed that basically takes interest rates to zero. They're pumping the system full of money, right? And that money's got to go somewhere. And so you saw, Tesla and GameStop and like basically every junk company that was out there was just going through the roof. And so SPACs got caught up in the exact same mania. And we had this frenetic period where, oh my God, the SPAC is buying an EV company. It's going to become the next Tesla. Let's get on board, right? And so they drove these things to obscene levels. And, I got to tell you, we couldn't sell fast enough. And every time we sold something, we felt bad about it because it just went higher, right? Like if we had not sold anything during those months, we would have had some obscene returns. But, that's not our game. Our game is not to generate 14% a month, right? We'd be ecstatic to generate 14% a year with low downside. So that's our game, it's a defensive strategy. We're trying to protect our downside scenarios, and just kind of churn out reasonable returns with low downside. So when that happened, like I said, we were selling, and then things go higher and we sell some more, and things go higher and we sell some more. And at some point, like some of these things were trading at $20 with only $10 in trust, right? Some of them still are. Like, actually, where's that DWAC? Everybody knows of this DWAC, which is buying, or has been, supposedly merging with Trump's social media platform, right? Like, for a brief period, this thing got over $100 with $10 in trust, and even today it's trading at $14, which is 40% above how much is in trust, right? So if that deal does not go through, it's going to be back down at just a little bit over $10. Like they've obviously been earning interest as well, but it's about 40% loss scenario there if things go wrong.
Wow.
So
and yeah, the way you've explained it is some investors or advisors look at this almost like fixed income, where with a fixed income investment, you're buying it at You're putting $100 in and they're guaranteeing you, a 3% return over a year or 2 years or 5 years. Whereas this type of investment, if you buy it at the $10 a unit price, you're guaranteed your $10 plus whatever interest. And then you have the option for private equity like upside.
Correct. Yeah, and so if you actually flip to the next slide, I'll actually show this to you as a live example.
Yep.
So this is a SPAC. It's called Rights Acquisition Corp 2. So their first one did phenomenally well. It trades on the exchange. The unit ticker is up there, RONI/U. There's two parts to it. There's a common share, which is RONI, and then there's a warrant, right? And in this particular case, they IPO'd in June of 2021. They had a 2-year timeline. So in December of 2022, about a year and a half later, they announced an acquisition of this company called Net Power, right? So it IPO'd at $10. Again, we traded this thing around. So this is an idealized trade, assuming that everything's static. So we have been trading this thing around since the beginning. But if you bought it at $10 on the IPO, currently the unit is trading at $10.60, right? And the common share is trading at around $10.30. But the warrant is trading at $1.35. So what happened is we have 3 pieces that we can actually trade if we wanted to, right? The reason I'm concentrating on the unit is that's what we bought at $10, and there was $10 in trust, and then the warrant represented a little bit of upside potential that should they find a deal, right? So currently, because they've been earning interest for a little while, there's about $10.20 in trust, right? So, and their current expiry is June of 2023. And by that time, we estimate that there will be about $10.30 in trust, right? So if the deal does not go through by then, right, you're going to get back $10.30. Well, currently the stock is trading at $10.30, right? So right now it's just kind of you're buying it at what the trust will be. So if you just kind of buy it on an unlevered basis, you get the potential for even more accretion, or you get your money back, right? For us, the main money has sort of been made because we bought this thing at 10. We've actually sold off our warrants since the deal announcement. So this thing came in at with a I think it was let's see how much warrants they had, with a quarter warrant, right? So basically, with the unit, you had a quarter of a warrant. So if you bought 100 units, basically that equates to 100 shares of stock plus 25 warrants.
Okay.
Right. So we've actually sold off our warrants. We've made money on the position already. We've sold off a chunk of our stock, and maybe we'll keep a little bit as it trades. But we've already made our money on this trade for the arbitrage position, and it's been a fairly decent return, right? Because unlevered, if someone were to have traded it, that's 6% with no downside, right? Up until now, and then on a levered basis, it's actually a little bit more than that. And we've already locked in our returns because we've sold off those warrants. And like I said, we may trade the stock around as well. This thing has not gone to vote yet. They're currently expected, by June, to have turned into the new company, and we'll see what happens. This particular team is a very well-known team. They've been very successful with prior deals. They're one of the few SPACs out there where their prior deals are actually trading above where the deal was done. And so that's why everybody's kind of excited about it, and the warrants are trading where they're trading.
Okay. So right now, if it wasn't levered, the return based on just selling those warrants is 6%. And then approximately how much leverage would you use on an investment like that?
It will change, and again, we don't look at it on a name by name basis. We basically apply leverage to the overall portfolio, and
Mhm.
so we'll range anywhere from 0 leverage up to 3 times leverage, depending on what's happening in the markets and what the
Mhm.
opportunities are. So we that number moves around for us a fair
Yeah.
bit.
Okay. So it could be up to an 18% return locked in on something like this if it was max leverage.
Correct, and we try not to go max leverage.
Yeah. Okay.
Yeah.
And then you have upside potential. So you're kind of seeing if that unit price trades above the 1060 where it's trading now.
Uh, that's right, and it may or may not. That's why, like I said, we've taken out most of our money on this particular trade. I didn't throw this up just to kind of concentrate on it. It's just more of a live example that people can kind of look at. Because
Yeah.
up until now we've just kind of talked about theoretically what it is. So this is a
Yeah.
live example of something that if somebody wanted to, they could pull up the tickers and they can kind of see what's happening with it.
Yeah.
But so like even today, it's the common stock itself is trading at $10.30,
Okay.
right? So, and that there's 1030 in, there will be 1030 in trust by the time the deal happens, by
Okay.
the time the deal goes through, and
Gotcha.
maybe it'll go higher, maybe it won't. But typically at this point, what we'll do is we'll look around and see, okay, what else is out there that if we sell this, are there better opportunities that are still trading below trust? Right?
Yeah.
So that's why we've taken out our capital, we've taken out a return, and we'll look around for something better if there is something better, and we'll trade these things around. I will tell you that these particular units, were trading below $10 not too long ago. All right, when when everything was dire,
Mhm.
so you could have picked these things up for below $10 as well,
Okay.
and we did.
Yeah. Awesome. Well, thanks for that example. I think that does help kind of clarify the process and the steps. And, this kind of shows like an ideal position that you'd like to be in where you've already locked in a profit on the warrant
Yeah,
and there's only upside if the share price goes up. Otherwise, you're getting your $10.30 or $10.20 back.
correct.
Plus, which will go up to 1030, I think you said, by the end
Yeah,
of the period.
perfect. Can I just ask one thing? Because I know compliance is going to beat me over the head. Can you
Yep.
scroll down a little bit more? Because
Yeah.
yes, they want to make sure that everyone sees this part too.
Absolutely. And I can flash these up on the screen after
Yeah.
at the end of the
Yeah,
call as well.
exactly. It's we want to make sure that we stay on the right side of regulations. So like nothing here is to be construed as investment advice. We're just talking about what we do, and then obviously everybody has to read the prospectuses.
Absolutely. That sounds good. And then I'm just going to go back to the fun fact sheet just for a second.
Mhm.
And then, maybe we could, since inception, it wasn't a full year in 2019. It was 7%, 65%, 13%. Last year, down 0.22 when the market was down 19.44 in the US. So amazing outperformance there. So far this year, plus 1.11. Do you have any way of forecasting in this type of market what you think 2023 might look like, or is it more you just kind of go and try to play the best you can as these deals arise?
We always go and try and play the best we can because again, you never know what happens, right? In 2021, there's no way in a million years that I would have forecasted that we'd have double-digit months, right? Like it's just
Yeah.
no way.
In
What I
yeah.
what I can
2020 and 2021
and 2022, right? Like,
yeah.
and that was at the peak of all the exuberance that was out there, not just in SPACs, but across the board, right?
Mhm.
Like if you look at, the ARC fund as a proxy for non-profitable tech, that's pretty much what every non-profitable company was doing, and SPACs were along for the ride, just like everything else, right?
Mhm.
The key for us was that we have a sell discipline, so we're selling, along the way, and we will start buying on the way down, right? Like it's making sure that we always have that cushion of above trust value, so that we don't actually lose capital.
Mm-hmm. Yeah.
So,
And I know I've read, it might be on your website, is the target still for this investment over the long term between 8 and 11% over a period of time?
that's what we're kind of, we'd like to target.
Yep.
But again, it depends on what the market gives us, right? So like, last year, as you pointed out, we're pretty flat. And the year before that, we did better than that. So it's over a long cycle, that's kind of our bogey that we shoot for. But if the market were just to shut down, then obviously we can't do that.
Yeah.
But we still try and go out there and do the best we can.
Yeah, and we appreciate that because ever since had you in clients' accounts, you've protected on the downside significantly, provided lots of upside. So risk-adjusted returns are very, very strong. And, we always appreciate how available you make yourself to us. Every month we touch base with Kamran, and he's always there to pick up the phone and have a conversation with us. So we always really appreciate your time and how available you make yourself for, such a big job that you have already.
No, thank you. And it's important for us that, our investors know what it is that we're doing, because, if we get another March 2020, if we have educated clients, they know what we're trying to do. It's easy. It's much easier for us as well to kind of pick up the phone and say, okay, that opportunity I told you about that comes around once every, a blue moon. This is it. Please send in a check.
Yeah.
Right. So no, and so we appreciate the opportunity as well to get in front and always open for a conversation.
Yeah, and we appreciate that too, because in those monthly calls that we have with you, you kind of can tell us when, if the portfolio went down by 4.75% like it did in March of 2020, you have insight that now's the time to add money, and then we'll communicate that with our clients and try to increase allocations to take advantage of kind of some of these short run forecasts that you can provide. So yeah, we always appreciate everything that you do for us, Kamran.
Awesome.
All right. Thanks for joining us today, and hopefully we'll have the opportunity to talk again soon.
Looking forward to it. Thanks, Cody.
All right. Take good care.
Bye-bye.